So today's topic which we are going to start is provisions and contingencies. See, before starting this topic, first of all, we have to know the meaning of these two terms. What do you mean by provision and what do you mean by contingencies? So first we'll discuss about provision. See, in order to understand provision, we have to know about three things. Okay, like why we have to recognize it in the books, why you have to show it in the books, what's the reason behind that? Like this, one more thing, this comes under IAS 37. Okay, all these three provisions, contingent liability and contingent assets. Now, provision is always shown as a liability. Provision will be shown as a liability. Now, what kind of liability? Because we know now what is the definition of liability. Liability is nothing but an obligation for the company. Do you agree with that? Liability is an obligation.
Yes, ma'am.
Now, why provision is shown as a liability? And that two things are there, timing and amount, both are uncertain. So, for provision, there's uncertain timing and uncertain amount. And why it is shown as a liability, that will come to know. So definition of liability is already known to us. It is an obligation of an entity to transfer economic benefits as a result of past transactions or events. Now, provisions from other type of liabilities also. Like in previous lessons, we will find that accruals are also a liability. Okay. Payables are also a liability. All this comes under current liability classification. Same is for provision also. But provision will be a different type of liability as compared to accruals and prepayments. Why? What thing is like differentiating provision from accruals and prepayments? Only one term, that is uncertainty. For accruals, basically we know that the amount will be certain to some extent. For payables, we definitely know that the amount will be certain. So these are the two types of liabilities for which we know that the timing will be certain, the amount will be certain. Only provision is that kind of liability for which we doesn't know about the timing or amount, because both are uncertain. So that is the point of differentiation between provisions and other types of liability. So now whenever we are reading something, or whenever we have to read something or go through about something in accounts, we need to know whether it is recognized in the books or not. So two things, we till now you have known that two things are very important. One is recognition criteria, another one is measurement criteria. So when once you are saying that it is an uncertain timing and amount, how would you recognize it, or how would you measure the amount for the provision? So for that, certain things are given in IAS 37, and they say that provision should be recognized. That means it should be shown in the books. Recognized means shown in books. So provision will only be recognized as a liability when all three of the following conditions are met. That means meeting two conditions will not be sufficient. Meeting one condition will not be sufficient. We have to like meet with all the three conditions, then only we can show it as a liability. So we'll go through the conditions. What are the conditions? An entity has present obligation. Present obligation means now, right now, the company will be having an obligation. Now that obligation can be legal obligation or constructive obligation as a result of past event. So as a result of past event, like in past, definitely something has happened because of which now the company is liable to pay certain amount. Okay. Second thing, it is probable. What do you mean by probable? Probable means more than 50% chances are there that transfer of economic benefits will be required to settle the obligation. That means the entity will incur certain type of expenses. So definitely entity will incur expenses to settle that particular obligation. And third is, for that we can make a reliable estimation. Like we can make an estimation that how much will be the amount required to settle the obligation. So three things are to be satisfied. First is entity has present obligation, which can be legal obligation or constructive obligation. Now, what do you mean by legal obligation and constructive obligation? That I am going to explain. Basically, what do you mean by obligation? Obligation, we can say the business owes something to someone else. That means business owing something to outsiders. Okay?
Yes, ma'am.
Owing something to some outsiders. That is kind of obligation. Now they have classified this obligation into legal and constructive. So legal obligation arises from a contract and might, for example, include like warranty sold with products to make goods, any repair required within a certain time frame. So suppose we'll take example of certain product. Like there is a AC manufacturing company. Okay. So definitely they are selling AC, okay, air conditioners to people. And with that sale, they are giving a guarantee that 2 years we are giving a guarantee that nothing is going to happen. If something happened to our product, we will get it repaired without any cost, okay, within that particular time frame, within a period of 2 years, okay. So whenever, like suppose we'll now take example Mr. A. Mr. A bought an air conditioner and within 1.5 months there was some kind of defect or problem in the air conditioner. So definitely he might go to the entity, he might go to the company and get the things repaired without any cost. Why? Because they have given a time frame of 2 years. Within 2 years, if anything is going to happen, they will repair it free of cost or they will replace it free of cost. Understood? So that is kind of termed as legal obligation, which is by law the entity bound to perform. Clear?
Yes, ma'am, clear.
Now, second kind of obligation now you'll understand which is constructive obligation. So constructive obligation is nothing which is like implied upon the company or which is forced by the law or by any kind of act or any kind of statute upon the company. It arises through past behavior. That means the company has taken this obligation on its own. No one has forced the company to like oblige with this particular condition, but company has through past behavior and action where the entity raised a valid expectation. Now through past behavior, sometimes it happens now, like there are certain kind of companies, we can take example here also. One example is given. And because of this, now the expectation of the customer will increase that the company is going to do this for us, na? So it will carry out a particular action. That becomes a constructive obligation. Like a constructive obligation would arise if a business which doesn't offer warranties. So here we have talked about legal obligation. Here they are giving warranty period of 2 years. And in that particular period, if certain thing happens to their product, sold product, they will definitely repair it within that particular period. But what about constructive period? So here one example is given. Business is not offering any kind of warranties on its product. But definitely it has a history of usually carrying out free small repairs on its product so that customers have to come to expect this benefit when they make a purchase. So now what they are trying to explain with this constructive obligation, that by law the company is not forced to do anything. Legally the company is not forced to do anything, but company has made itself a legacy. Company itself has made a legacy that whatever product they are selling, they don't offer any kind of warranties on those products, but still, if any kind of defect is happening, certain small manufacturing defect or some small kind of repairs, that will be done free of cost. So now customers' expectation will increase now for those kind of companies. Like we purchase from this kind of company, and we know that the company is not offering any warranty. Still, the company always helps us when there is certain kind of small repairs, and company is not charging anything for that. So we also have hopes with the company now that whenever we are going to purchase the product of that particular company, any kind of repair will be done free of cost. Did you get my example?
Yes, ma'am, I did.
So that is the difference between legal obligation and constructive obligation. So for both, be it legal obligation or be it constructive obligation, company is going to incur expenses, na? Why? Because this repairs and all the company is doing free of cost. So for that, the company has to create a provision. So this is how we satisfy the first point, that is entity has a present obligation, be it legal or constructive, as a result of past event. In past, the company has made a sale. In that particular sale, defect has appeared and the company, legally the company has given a warranty period, or in constructive obligation, the company not offering warranty period, still doing small repairs free of cost, that will incur certain kind of expenses to the company. So for that, company has to create a provision. Clear? Why? Because company in its account, company has to show all the expenses and incomes, revenues generated and expenses incurred. So this is also kind of expenses which the company might incur in future. So for that, the company should be ready with a particular provision. So first point is satisfied. Second point, it is probable. Probable means more than 50% chances are there that there will be some transfer of economic benefits. That means the company can incur certain expenses, okay, to settle this particular obligation. So definitely in this defective goods, whenever we are going to make any kind of repairs, expenses will be incurred, and that is termed as transfer of economic benefit. And for this third thing, see, in accounts, everything is shown in terms of figures, na? So we have to make a reliable estimate that this might be the expenses with regard to provision. Okay, we can incur this kind of expenses. So that is about a reliable estimate. The reliable estimate can be made of the obligation. Tell me, all these 3 points are clear? How we show or how we recognize provision as a liability?
Yes, ma'am, they're clear.
All clear, definitely?
Yes, ma'am, definitely.
Okay. So now we'll go through the accounting entries. So now for everything, how the business shows the accounting treatment of provision. In the first year, when the business is creating a provision, for the first year, now remember the full amount of provision should be debited to statement of profit and loss and credited to statement of financial position. So it will have effect on both SOPL and SOFP. How it is going to have effect? We will show it as expenses. See, basically expenses are shown in SOPL, na? And liabilities and assets are shown in SOFP. So we have seen that provision is a liability. So this is how it is credited to SOFP, because liability are to be shown in the credit side. Okay. We know that in accounting question, you might have read that if there is increase in liability, that will be shown in the credit side. Okay,
Yes,
do you know this?
Yes,
Now, so every year this provision is to be shown, and when something is of recurring nature, we show it in statement of profit and loss. So every year when this provision is to be shown, that means it's of recurring nature. So this is how we show it in statement of profit and loss. So the accounting treatment will be debit expenses and credit provision. Expenses in SOPL and provision in SOFP. Clear? That is for first year. when first time the provision has been created by the company. Now next, and that's not the end. It's not like in first year only we will create provision and we'll keep on carrying on the same amount year after year. In subsequent year, if any adjustment is required, that should also be done. So how and what procedure we follow for next year or subsequent year? For next year, we'll calculate the new provision required. Okay. So suppose in the first year, the provision required is $500. Okay. In first year, provision is $500. Now new provision required is $800. Okay. So that is more than the old one. Na? This is more than the old provision. Okay. Now compare it with the existing balance. By how much it is more? By $300 it is more. Do you agree with me?
Yes, ma'am.
So old provision was 500. New provision required is 800. So excess provision is 300. Now this is what? This is increase in provision. Na? So for increase, we will pass the entry like $300 expenses and $300 provision. Now suppose if the new provision is say 400. So this is what? This is less than the old provision. Okay. So in that scenario, we'll pass a reverse entry. How? Debit provision by how much? Because our provision is decreasing by $100. Do you agree with me? Is it clear? Old provision was 500. Okay. Now if new provision is 400, that means there is a decrease in 100, na?
Yes, ma'am.
So in that scenario, we'll pass a reverse entry, debit provision and credit expenses. Why? Here our liability is decreasing. And when our liability decreases, we show it in the debit side. Clear?
Yes, ma'am.
And same is the nature of expense. Expense decreases, we show it in the credit side. Liability decreases, we show it in the debit side. Expense decreases, we show it in the credit side. I hope you are aware about this effects.
Yes, ma'am, I am.
Okay. So that was the concept of provision. Now we'll check one example. How actually the entities show provision in their books of account. So here one example is given. A business has been told by its lawyer that is likely to have pay $10,000 damages for product that failed. So this is first year's provision in which the lawyer has clarified that there can be a damage claim of $10,000. The business duly set up a provision at 31st December 2017. However, the following year, the lawyers found that the damages were more likely to be 50,000. So what we can see, this is 40,000 more than the old provision or what the lawyer has said. Okay. So how is the provision treated in the books of account for the subsequent years? Like in 31st December, for first year, how the provision will be treated, and for second year, how it is to be shown. Okay. So in first year, the business will first of all create a provision, same debit expenses on credit provision. Okay. The same accounting treatment we have to follow. This is what? This is for first year. That is 2017. Clear?
Clear, ma'am.
Now, so same is to be shown in, they have given the extract of profit and loss also. Expenses, provision for damage, 10,000. And in SOFP, that comes under non-current liabilities, provision for damages, 10,000. Okay. Because it is uncertain when the amount. Why we are showing it under non-current liability? Because the timing and amount, again, in the definition we have read now that the timing and amount is uncertain. So definitely, but indeed it will be paid. But there are more than 50% chances that it will be paid. So that's the reason it is classified as non-current liability. Now in second year, in subsequent year, the provision need to be increased now. Why? Because actually we have seen the provision is 50,000. So it is increasing by how much? It is increasing by 40,000. So again the same kind of entry will pass for the next year, 2018. What will be the entry? Previously, we have created a provision of 10,000. Now total is 50,000. That means additional provision required to be created is of 40,000, which we already calculated, 50 minus 10. So the same entry we have to pass debit damages credit provision of new amount, that is 40,000. Okay. So PL will show 40,000 because this is the expense for that year, expenses of 2018. But in SOFP will show a total amount of provision. That means the previous amount plus the new amount required. Okay. So now instead of showing a provision of 10,000, we'll show a provision of 50,000. Is it clear?
Yes, ma'am, clear.
Now, so that was about the recognition criteria, the first thing. Now we'll see the measurement criteria. So how we are getting this amount that we should create a provision of 10,000 or we should create a provision of 50,000 and so on. So the amount recognized as the provision should be the best estimate. There is no hard and fast rule. Only in standard they are saying that it should be the best estimate of the expenditure. Like in previous sum we saw now that the entity has taken the help of their lawyers. So lawyers have made a best estimate that 10,000 can be the provision. Okay. Now, similarly, like if it can be 10,000 for firm A, same kind of business is done by firm B and they are creating a provision of 20,000. So it might vary from one person to another and one entity to another because they are showing the best estimate, and best estimate doesn't have a valid definition. Okay. So in measurement criteria, that's the reason they say that provision should be the best estimate of the expenditure required to settle the present obligation at the end of the reporting period, and the estimate will be determined by the judgment. So every person's judgment might vary, na? There are two persons, X and Y. X says that the provision should be 10,000. Y says that the provision should be 8,000. So both are having their own verification and validation for this particular amount. Okay. So that's the reason it is said that it is determined by the judgment of entity's management. And we know every entity has different management, and definitely the thinking point or the point of view of the management might not like it might be unlike with the other management or other entities management criteria. So it is depending upon the judgment of entities management supplemented by experience of similar transactions. And definitely when the business is a long history, so definitely from past trends also to some extent we can make the provision, or we can find out the amount of provision. So if provision relates to just one item, the best estimate will be the most likely outcome. Now, when a provision is needed that involves a lot of items, like warranty provision where each item has a warranty attached to it, then the provision is calculated using the expected value approach. And how this expected value approach is calculated, taking each possible outcome and weights it according to the probability of that outcome happening. For that, we have a very good example also here. First, I'll tell you about example and then we'll discuss about difference between provisions and accruals. So example, like Parker company sells with a warranty under which customers are covered for the cost of repairs of any manufacturing defect that becomes apparent within first 6 months of purchase. Past experience and future expectations indicate the following patterns of likely repairs. In 75% of Parker company's goods, there is no defect. That means no cost. Okay. No cost of repairs. In 20% of goods, there is minor defect. And for this minor defect, we are going to incur a cost of $1 million. In 5% of goods, there are major defect. So that will cost us $4 million. Okay. So here under expected value approach, we are going to find the value of provision. So under expected value approach, we read now in the definition that it should be upon the weights of various items. Okay. So here the particular goods is divided into 3 categories. So the expected cost will be 75% of 0, that is 0. 20% of 1 million. 20% of 1 million is how much? One second.
20 lakhs.
Huh?
20 lakhs.
I will calculate. 20% of 1 million will be 200,000. Okay. And 5% of 4 million. Again, 5% of 4 million is also 200,000. That means 200,000 plus 200,000, we are getting 400,000. So the Parker company need to create a provision of 400,000 according to expected value approach. Okay. Did you get this example? It's a very simple example.
Yes, ma'am.
So now I'll tell you the difference between accruals and provisions. So again, it's very easy to remember this difference also. Again, one word is enough, that is uncertain. For provision, the liability is uncertain timing and amount, but for accrual, the timing and amount to be paid is almost certain. What is accrual? Accrual is, we can say, something which is outstanding. So definitely when some expenses are outstanding, we know now how much will be the outstanding expenses. Clear? Do you
Yes,
agree with this?
Yes,
You should be knowing now that your outstanding is this much. But for provision, there is uncertain timing and amount. So only one word is enough, uncertain timing and amount, to differentiate between provisions and accruals. Is the difference clear?
Yes, ma'am, it's clear.
Okay, so with this, we have ended provision concept. Now we have to discuss about the next concept, that is contingent liability and contingent assets. And here also we have to know about these two terms. What do you mean by contingent? So contingent is a term which says that, like, it is related to future, first of all. Okay. What kind of future event it is related to? Something which is uncertain. Again, the word uncertain is coming here. Okay. So it is related to future event which is uncertain, and the amount or whether the liability will be incurred or not will be dependent upon occurrence or non-occurrence of that future uncertain event. Occurrence or non-occurrence of this future uncertain event. So now we'll go through the definition as it is defined in the standard. A possible obligation that arises from past events. So this is same like what we have studied in provision, and whose existence will be confirmed only. So from here, the terms are getting changed. Only by occurrence or non-occurrence of one or more uncertain future events, not wholly within the entity's control. So these uncertain future events are not under the control of the entity. So present obligation that arises from past event but is not recognized. So for contingent liability, remember one thing, it is not recognized in the books, but it is given as a disclosure in the notes. Disclosure in notes. Why it is not recognized in the books? Because it is not probable. Like, we can't say to some extent that more than 50% chances are there that this is going to happen. So that's the reason it is not probable that a transfer of economic benefit will be required to settle the obligation. And the amount of obligation cannot be measured with sufficient reliability. So again, these are the two terms which are not matching with provision. That's the reason it comes under contingent liability, and that's the reason it is not recognized in the books. But yes, definitely the entity has to give disclosure for this, and disclosure is given in the notes. Okay. So previously we have seen that probable means more than 50% chances are there that it is going to happen. But the same is not in contingent liability. So that's the reason it is not recognized. Okay. Now I'll give you one example also. In book, contingent liability example is not given. But first we'll check the text. Contingent liability should not be recognized, but they should be disclosed in the notes. And what are the disclosures? A brief description of the nature of liability, an estimate of its financial effect, an indication of uncertainties that exist, and the possibility of any reimbursement. So now here I'll take one example. There's a company A. Now in that company there's an employee X. Okay. So name of the company is A. Name of the employee is X. He was working, this employee was working in a company which was removed. So employee was removed from the company. Okay. Removed from the company. Now this employee says that he was removed on certain things which was unjustified. Okay. So unjustified, on unjustified criteria, this employee was removed. So what happened? He posted a case against the company. Okay. So definitely whenever an employee is against the company, the matter is in court. Okay. Now when the matter is in court, everything is dependent upon the judgment. Okay. So here we are showing it as a liability, a brief description that ex-employee who was working in a company has lodged a complaint against the company that he has been removed from the company on unjustified grounds. Okay, so that is about the brief description. Clear? First point?
Clear, ma'am.
Second, now what can be the estimate of financial effect? That means this will be the compensation which is charged by that particular employee. So he is asking a compensation of $1 million. Okay. So that is estimate of its financial effect. Now if the judgment comes in favor of that particular employee, so definitely the company has to immediately pay $1 million. So that's the reason they have to disclose this thing in the financial effect. Okay. Third thing, indication of uncertainties that exist. So uncertainties means in what circumstances the employee might win this case and the possibility of any reimbursement. So the same amount of $1 million, is the company able to reimburse it from someone else? That means to get the amount adjusted from someone else, or the company has to bear all the expenses. So this is in this company has to disclose about the contingent liability. Is the example clear?
Yes, ma'am.
Is the concept of contingent liability clear? Like it is dependent upon? Huh?
Ma'am, could you tell the difference between contingent liability and provisions once more?
Yeah, see, in provision, we have to satisfy 3 criteria. Na? It is probable that there will be transfer of economic benefit, which is not the case in contingent liability. Okay. And second thing, the amount can be measured reliably measured in case of provision. Like we saw in the example previously, na, that the lawyer has given a reliable estimate that the provision can be of some $10,000. But for contingent liability, no reliable estimate can be made. So these 2 points are different from provision as far as contingent liability is considered. Okay. One thing, there is probability is less, and second, we can't is like reliably measure to what extent the loss can be, or the company can incur the liability to what extent. Why? Because the event is dependent upon future, and the event is uncertain also, and the total thing, the whether the company will incur a liability or not is dependent upon the happening or not happening of that event. Okay, uncertain future event. Clear?
Clear, ma'am.
Hello.
Ma'am, clear, ma'am.
Okay. So one more thing we have to discuss, that is contingent asset. So same like contingent liability, contingent asset is also the same thing, but here when we say asset, that means the company is going to have benefit. Okay. Asset is a kind of benefit for the company now. So possible asset that arises from past event and whose existence will be confirmed by occurrence of one or more uncertain future event, not wholly within the enterprise's control. Okay. So same is for contingent asset also, but here only difference is here the company doesn't have to pay anything. Here the company is going to receive, like company is expecting to receive something. Okay. But that is again dependent upon future event which is uncertain. Clear? Hello, Hamshika, it is clear?
Yes, ma'am.
Yeah. So contingent asset is also not recognized, but it is to be disclosed. Okay. If it is probable that economic benefits associated with the entity will flow to the entity. So why disclosure is required? Because when we prepare financial statements, we are preparing financial statements for stakeholders. And we are taking a responsibility that everything will be disclosed to them. We will keep everything transparent. So that's the reason we disclose everything. Okay. Be it any kind of provision, be it any kind of contingent liability or contingent asset. So same description we have to give, a brief description of contingent asset along with estimate of its likely financial effect. That means to what extent the company might gain. Okay. If the flow of economic benefits associated with contingent asset becomes virtually certain. So contingent asset is something which is uncertain. Now, if in future we come to know that definitely we are going to receive the amount. So now in that scenario, when it is definite, it will be recognized as an asset. Clear? So now this in that particular year, the contingent asset becomes an asset. Clear?
Yeah, ma'am.
When the contingent asset is becoming an asset, when the company becomes certain, virtually certain that the company is going to receive the benefit. Okay?
Okay, ma'am.
$1,000 and this is virtually certain. When it is virtually certain, we'll recognize it as an asset or contingent asset. Tell me whether it is asset. Huh?
Ma'am, it is certain means contingent.
No. Virtually certain means asset. When it is uncertain, it is a contingent asset. Okay.
Okay.
So when it is clearly given, I underline now, when it is clearly given, it is virtually certain, it will be recognized as an asset. Here in example, company expect to receive damages and this is virtually certain that the company will receive damages. So this will be shown as an asset, not a contingent asset. Clear?
How, ma'am, could you repeat that?
See, when the company is saying that the company is going to receive the benefit and that is definite. Definite means that is certain. Definitely the company is going to receive the benefit. Okay. So in that scenario, we can recognize as an asset now. What's the definition of asset? Future economic benefits will flow to the entity. Okay.
Yes,
So
ma'am.
definitely
Yes.
benefit is coming to the entity. So company is expecting to receive damages from someone, be it XYZ. Okay, and that is definitely certain. Definitely will show it as an asset, not a contingent asset. But if the company expect to probably receive damages of $100,000, it will be a contingent asset. Why? Because here the word certain is not there, but probable is there. Okay, so there is a difference between probable and certain, na? Certain
Yes,
means
ma'am.
we are going to definitely receive the amount. Probable means we may receive, may not receive. So if that is the criteria that we may receive, may not receive, it's a contingent asset, not an asset. Clear?
Yeah, ma'am.
Tell me, are you sure or should I explain again?
Yes, ma'am. Clear, ma'am. I understood.
Clear, na? Okay. So now, here a flow chart is also given about IS 37. Like if three things are satisfied, whatever we have read, it's nothing but a recap of that. Okay. I'll show you the flow chart. So here three things are to be satisfied. First criteria, present obligation as a result of obligating events. Second criteria, probable outflow of future economic benefits. Third criteria, we can make a reliable estimate of that. If every three things are yes, we'll show it as a provision. Provide it as provision. Okay? Clear? Now, what if this first point is no? So when this first point becomes no, present obligation as a result of obligating event is no, we have to check whether it is possible obligation. If possible obligation is a yes, and there will be a possible outflow. Possible means it may happen, may not happen, uncertain. Okay? So whenever something is uncertain, that will be shown as the contingent liability. And if possible obligation answer is also no, we don't have to show anything in the books of accounts. So do nothing. Nothing is to be shown in the books. Okay. So if all the three criteria are fulfilled, we have to show it as provision. If first criteria is a no, we have to check uncertainty. If uncertainty is there, we have to show it as contingent liability. And if uncertainty is also not there, we don't have to do anything for that. Clear? So that is what we try to understand IAS 37, which is with regard to provisions, contingent liability and contingent asset. So that is the end of this lesson. All the points are clear, Hansika?
Could you repeat that?
Yeah, that is the end of this lesson. So like each and every point was clear or not, that I am asking.
Yes, ma'am, it was.
Okay. So once you can refer it again. Okay. If you have any doubt, you can further discuss it. Okay. So I'm just logging off now, Hamsika. Just check it out once. Clear?
Yes, ma'am. Clear, ma'am.
Okay. Thank you.
Yes, ma'am. Thank you, ma'am.